Welcome back to Bonnie's Life, where we cut through the noise and decode the markets with surgical precision. If you are looking for sugar-coated hopium, you are on the wrong channel. But if you want the raw, unvarnished truth about how to trade this current crypto market, whether you are a day trader, a swing trader, or a long-term investor, you have arrived at your destination. Today, we are dissecting a market that is testing the patience of even the most seasoned veterans. We are going to break down the Federal Reserve's latest curveball, the impending changing of the guard with Kevin Walsh, President Trump's national address tonight on the Iran situation, and the geopolitical powder keg that is the Strait of Hormuz blockade. Grab your coffee or something stronger because we have a lot of ground to cover. And if you find value in this analysis, smash that subscribe button and hit the bell, because in this market, being late to information is being late to profit. Let us start by calling a spade a spade. What type of market are we currently trading? We are in a high-stakes, range-bound consolidation phase with a distinct bearish bias. This is not a trending market. This is not a breakout market. This is a chop zone, a meat grinder designed to chew up over-leveraged traders and spit them out. The market is currently trapped between the $75,000 support floor and the formidable $80,000 resistance ceiling. If you are trying to trade this like the euphoric bull run of late 2025, when we hit $126,000, you are going to get liquidated. The smart money is patient, disciplined, and strategic. That is what we are going to be today. Let us look at the hard data, fresh off the press from CoinGecko and CoinGlass as of April 30th, 2026. Bitcoin is currently hovering around $76,393. The 24-hour trading range has been tight, between $75,102 and $76,528. The total crypto market capitalization sits at $2.63 trillion, having shared over 2% in the last 24 hours following the Fed announcement. Bitcoin dominance is creeping up to 60.01%, and this is a critical signal. When Bitcoin dominance rises in a declining market, it means capital is fleeing altcoins and seeking refuge in Bitcoin. It is a classic risk-off rotation within the crypto ecosystem. Ethereum is trading at $2,263, Solana at $83.31, and XRP at $1.36. The 24-hour trading volume for Bitcoin alone is $37.3 billion, while total futures volume across all exchanges reached $180.4 billion. Now let us talk about the sentiment indicators, because numbers without context are just numbers. The Crypto Fear and Greed Index has plunged to 28, placing us firmly in the fear zone. Just 3 weeks ago, we were flirting with greed territory. The average RSI across the market is 45.98, which is neutral but leaning bearish. The altcoin season index sits at 36, also neutral, confirming that we are not in an altcoin season and capital is concentrated in Bitcoin. When the market is fearful, the weak hands sell, and the smart money positions itself for the next move. Warren Buffett said it best: be greedy when others are fearful, but timing is everything, and let us talk about open interest and liquidations, because this is where the real story is told. Total open interest across the derivatives market is a staggering $119.13 billion. Bitcoin alone accounts for $54.46 billion of that. Ethereum carries $31.06 billion. What does this mean? It means there is a massive amount of leverage still in the system. And when you have high leverage combined with a choppy range-bound market, you get fireworks. In the last 24 hours, we saw $370.84 million in liquidations, up 18% from the previous day. Bitcoin contributed $93 million of those liquidations, Ethereum $119.5 million, and Solana $23 million. The vast majority of these were long positions. Traders tried to catch a falling knife after the Fed announcement, and the market punished them mercilessly. The funding rates on Binance BTC/USDT have flipped to negative 0.0033%, Bybit at negative 0.0052%, and OKX at negative 0.0064%. Negative funding rates mean shorts are paying longs, a clear signal that bearish sentiment is dominating the derivatives market. Here is something most analysts are not talking about. The options open interest has surged by 392% to $39.97 billion. This is an enormous spike that suggests institutional players are hedging aggressively. When you see options activity explode like this, it means the big players expect a significant move, they just are not sure which direction. The CME Bitcoin open interest is at $8.47 billion, up nearly 1%, indicating that institutional participation through regulated venues remains strong despite the fear. Now, let us pivot to the macroeconomic wrecking ball that hit the markets yesterday, the Federal Open Market Committee decision. The Fed held interest rates steady at 3.5% to 3.75%. That part was expected. Markets had priced in a 100% probability of no change. What was not expected was the level of dissent. We saw an 8-4 split vote, the highest level of dissent since October 1992. That is 34 years of consensus broken in a single meeting. Governor Stephen Miran, who has been the lone dove since joining the board in September 2025, voted for a quarter-point cut. But the real shock came from the other side. 3 regional presidents, Beth Hammack of Cleveland, Neil Kashkari of Minneapolis, and Lori Logan of Dallas, agreed with the hold but strongly opposed any language suggesting future rate cuts. They specifically objected to the word additional in the statement, which implies the next move would be lower. The Fed's statement was unambiguous. Inflation is elevated, driven largely by global energy prices. The PCE inflation rate hit 3.2% in March, well above the Fed's 2% target, and climbing at its fastest pace in 4 years. This brings us to the changing of the guard, and this is where it gets really interesting. Jerome Powell just chaired his final FOMC meeting. His term as chair ends May 15, 2026. But in a move that surprised everyone, Powell announced he will remain on the Board of Governors, where his term does not expire until January 2028. This is unprecedented since Marina Eccles in 1948. Powell is essentially staying to guard the Fed's independence from political pressure. Enter Kevin Walsh, who cleared the Senate Banking Committee in a party-line 13-11 vote on April 29th. The full Senate could confirm him as early as May 11th. Walsh is a known hawk. He has called the post-COVID rate cuts the biggest policy error in 40 years. He plans to scrap forward guidance, shrink the balance sheet faster, and narrow the Fed's focus strictly to monetary policy. He wants to reopen the Treasury-Fed Accord and modernize it. The market is terrified. Morgan Stanley has already revised their forecast to 0 rate cuts for the entirety of 2026, with 2 25 basis point cuts not expected until January and March of 2027. If you are waiting for cheap money to fuel the next crypto parabolic run, you might be waiting a while, but the Fed is only half the equation. We have a massive geopolitical crisis unfolding that is directly impacting every market on the planet. President Trump's naval blockade of the Strait of Hormuz, dubbed Operation Epic Fury, has sent oil prices skyrocketing to $126 a barrel, a 4-year high. The Strait handles 20% of the world's oil and gas supply. Iran's oil exports have collapsed from 2.1 million barrels per day to just 567,000 barrels per day. Tehran is losing $500 million every single day. Trump rejected Iran's proposal to reopen the Strait, and today he is being briefed by CENTCOM on options for a new wave of military strikes. Iran's supreme leader has vowed to protect their nuclear and missile capabilities. Gas prices in the US have hit $4.30 per gallon, up $1.10 from a year ago. The GDP grew at just 2% in Q1, below expectations, while inflation is accelerating. This is the textbook definition of stagflation risk. Now, Trump is scheduled to give a national address tonight on the Iran situation. What is the market anticipating? The market is pricing in escalation. If Trump announces new military strikes, expect oil to surge past $130, the dollar to strengthen further, and risk assets including Bitcoin to face selling pressure. The correlation between Bitcoin and traditional risk assets has tightened during geopolitical crisis. However, there is a contrarian view. If Trump signals any willingness to negotiate or de-escalate, we could see a sharp relief rally. The market is positioned heavily short right now, and any positive surprise could trigger a violent short squeeze. Watch the oil price and the dollar index tonight. If oil drops and the dollar weakens, Bitcoin rallies. It is that simple. There is also the tariff situation that most people have forgotten about. The Supreme Court struck down Trump's sweeping tariffs under the International Emergency Economic Powers Act, and the first refunds are expected around May 11th. This is actually a mild positive for markets, as it reduces one source of inflationary pressure and uncertainty for businesses. Let us now talk about the Bitcoin spot ETF flows, because this is the institutional demand barometer. The data is concerning. On April 29th, the day of the Fed decision, we saw a net outflow of 1,800 BTC from spot ETFs. April 28th saw outflows of 1,160 BTC. April 27th was even worse with 3,350 BTC in outflows. That is over 6,300 BTC, leaving ETFs in just 3 days, worth approximately $480 million. The institutional bid that carried Bitcoin from $60,000 to nearly $80,000 is evaporating, without ETF inflows resuming at $100 million or more per day for at least 3 consecutive days. The breakout above $80,000 becomes significantly harder. Now, let us get tactical. Let me give you the technical setups and triggers for the next trades. On the daily chart, Bitcoin is consolidating between $75,000 support and $78,197 resistance. The 200-day simple moving average sits at approximately $84,500, acting as a major overhead magnet. The 21-week exponential moving average is right at $80,000. We have had 4 consecutive green weekly candles, forming a staircase pattern. But we were rejected hard at $79,477 on April 24th. The sellers at $80,000 are real, and they have defended that level multiple times. For short-term traders, the day traders and scalpers operating on 5-minute to 4-hour charts, this is a range trading environment. Your strategy is the ping-pong approach. Buy the $75,000 support with a stop loss at $74,200, targeting the mid-range at $77,000 for a 2.5 to 1 reward to risk ratio. Conversely, short the $78,000 to $78,200 resistance zone with a stop at $79,000, targeting $76,000. Watch the 1-hour RSI for divergences. If price makes a lower low but RSI makes a higher low at the $75,000 support, that is your bullish divergence entry signal. Keep position sizes small, no more than 2% of your account per trade. The market is hunting for liquidity on both sides. For mid-term traders, the swing traders operating on daily and weekly charts, you need to be watching 2 scenarios. Scenario 1, the bullish breakout. Wait for a weekly candle, close above $80,000. Not a wick, a solid body close. If that happens, enter long with a stop at $77,500, targeting the 200-day moving average zone between $84,500 and $85,000. That gives you roughly a 2 to 1 reward to risk. If we clear $85,000, the next target is $88,000, where there is significantly less overhead supply. Scenario 2, the bearish breakdown. If we lose the $75,000 support on a daily close, the next institutional demand zone is $72,000. If we break $72,000, the lower channel boundary sits at $66,000. For the bearish scenario, you can short the break below $75,000 with a stop at $76,500, targeting $72,000. For long-term traders and investors, your strategy is the simplest but psychologically the hardest. You are accumulating in the fear zone. The fear and greed index is at 28. Historically, buying when the index is below 30 and holding for 12 months has yielded average returns of over 200% in Bitcoin's history. You are not worried about the daily chop or the Fed's exact timeline for rate cuts. You are looking at the macro picture. Bitcoin is a finite asset with 20 million of 21 million coins already mined. The US national debt is approaching $39 trillion. Eventually, the liquidity taps will have to turn back on. Your strategy is dollar cost averaging into these dips. Allocate your capital into 3 tranches. 1/3 at current levels around $76,000, 1/3 if we dip to $72,000, And the final third, if we see a capitulation flush to $66,000. Your time horizon is 12 to 18 months, targeting the next cycle high. Let us now look at the global events calendar that will affect trading markets in the coming weeks. First, May 1st brings the ISM manufacturing PMI and a massive Ripple XRP unlock of 1 billion tokens, which could create selling pressure on XRP. May 5th is the merchandise trade balance report. May 11th is critical. The first Trump tariff refunds begin, and the full Senate could vote on Kevin Wash's confirmation. May 15th is the day Powell officially steps down and Wash takes over. This transition period between May 11th and May 15th is likely to be the most volatile window of the month. The June FOMC meeting is expected to be a non-event, with Bank of America noting the Fed will remain in wait-and-see mode. But Wash's first meeting as chair in June could surprise markets if he signals any policy shift. The Iran situation remains the wild card. Analysts at Rapid and Energy estimate Iran can hold out for 26 to 76 days before their oil storage fields, and they are forced to negotiate. That means this crisis could persist through May and into June, keeping oil prices elevated and inflation fears alive. Every day the Strait of Hormuz remains closed, the global economy bleeds. 20% of the world's oil supply is being choked off. This is not a minor disruption, this is a structural supply shock. Let me give you the strategies to successfully trade this market for each type of trader. For short-term traders, first, use tight stop losses, no wider than 1.5% from entry. Second, trade with the range, not against it. Third, reduce position sizes by 50% compared to trending markets. Fourth, watch the liquidation heat maps on CoinGlass for areas of concentrated liquidity. Fifth, avoid trading during Trump's address tonight, wait for the dust to settle. Sixth, use the volume profile to identify the point of control within the range. Seventh, set alerts at $75,000 and $78,200 and only trade when price reaches these levels. Eighth, if funding rates drop below negative 0.01%, prepare for a short squeeze. For mid-term traders, first, patience is your edge. Do not force trades in a range. Second, use weekly closes as your confirmation signal, not intraday moves. Third, watch ETF flow data daily. 3 consecutive days of $100 million plus inflows is your institutional confirmation. Fourth, hedge your positions with options. The 392% spike in options open interest tells you the smart money is doing exactly this. Fifth, scale into positions rather than going all in at one level. Sixth, monitor the DXY dollar index. A break below 97 would be bullish for Bitcoin. Seventh, keep 30% of your trading capital in stablecoins for opportunities. Eighth, set calendar reminders for May 11th and May 15th as potential volatility catalysts. For long-term investors, first, dollar cost average weekly regardless of price action. Second, focus on accumulation zones below $76,000. Third, ignore the noise of daily price movements and focus on the macro cycle. Fourth, consider allocating to Bitcoin over altcoins during this period of rising dominance. Fifth, use cold storage for long-term holdings to avoid the temptation of panic selling. Sixth, track on-chain metrics like exchange balances, which currently show 2.46 million BTC on exchanges, a level that has been declining over time. Seventh, remember that every major Bitcoin cycle has seen drawdowns of 40% or more from the all-time high before the next leg up. We are currently at 39.5% below the all-time high, which is historically a prime accumulation zone. Eighth, diversify your crypto allocation with some exposure to gold, which is at $4,613 and acting as the ultimate safe haven in this environment. Before I close, let me address the elephant in the room that nobody is talking about. The correlation between Bitcoin and gold has been breaking down. Gold is surging to all-time highs, while Bitcoin is consolidating. This divergence is temporary. In every previous cycle, when gold leads and Bitcoin lags, Bitcoin eventually catches up with explosive momentum. The question is not if, but when. The catalyst could be the Wash transition, a resolution to the Iran crisis, or simply the market recognizing that Bitcoin at $76,000 with a $39 trillion national debt is historically cheap. To summarize today's analysis, we are navigating a treacherous fear-driven consolidation market. The type of market we are in is a range-bound chop zone with bearish macro headwinds. The headwinds are strong: a hawkish Fed transition, sticky inflation at 3.2%, a geopolitical crisis in the Middle East driving oil to $126 a barrel, and institutional ETF outflows. But within this volatility lies opportunity for those who are prepared. Short-term traders play the range between $75,000 and $78,200. Mid-term traders wait for the $80,000 weekly close confirmation or the $72,000 deep buy. Long-term investors accumulate the fear with dollar-cost averaging. Keep your leverage low, manage your risk religiously, and do not let market emotions dictate your strategy. The market rewards patience and punishes impatience. Stay sharp, stay disciplined, and remember, in markets like these, capital preservation is the first priority and profit is the second. I will see you in the next episode of Bonnie's Life. Stay safe out there.